Guys, today we will discuss how to value bond using spot rates. Now, first we discuss what are spot rates. Spot rates are YTM of zero coupon bonds. Now, using spot rates is a more theoretically or a more fundamentally correct approach in pricing bonds, right? Previously, we had discussed that we were valuing bonds using a single discount rate, or we were valuing bonds with a single market rate of interest, right? Or we were valuing bonds with a single discount rate, which was the YTM. When we do that, that is not a correct approach. That is not a fundamentally sound approach, right? First, we discuss why it is not a fundamentally sound approach, why using the YTM is not a fundamentally sound approach, and we also discuss why using spot rates or a sequence of spot rates is a more fundamentally sound approach. So, guys, first we have to discuss, when we discuss this, we have to first discuss that longer term bonds are more volatile than shorter term bonds, right? Now, we've discussed this in the past, I'll just repeat it again. I'll just repeat this again, right? Longer term bonds, guys, are more risky to investors than shorter term bonds because they block the investor's money for a longer period of time, over which, say, a negative event may impact the price of the bond or a more attractive investment may arrive, right? So, let me give you an example. Say this is an investor A, this is an investor B, right? Both invest in US Treasury bonds, right? The coupon rate for the bond in which investor A has invested is 3% and maturity of this bond is 2 years, right? And the coupon rate for the bond in which investor B has invested is say 3%, but here the maturity is 10 years, right? Now say guys, 1.5 years have passed and the market rate of interest have increased and the US government is now issuing fresh bonds at 4%, right? Not at 3%, but 4%, right? Why? Because the market rates of interest have increased. Now, this would hurt both the investors as their bonds would now become less attractive. Investor A, however, will not be affected as much because the 2-year bond has only a fewer coupon payments only, right? It would actually have, since 1.5 years have passed, it would have only one coupon payment pending. And he would also receive the par value within 6 months, right? It is a 2-year bond, 1.5 years have gone by, so there would be one coupon payment pending, right? And the investor A, the bond in which investor A has invested will pay the par value within 6 months, right? But investor B, who holds a 10-year bond, right, will have larger number of coupon payments pending, right? Or in other words, we can say that he would receive lower coupon for a longer period of time, right? He would have larger number of coupon payments pending, but those coupon payments would be lower than the current rates in the market. So he would receive lower coupon for a longer period of time, right? So he can either sell the bond or he can hold the bond, right? If he intends to hold the bond, right, he will have to wait for 8.5 years to receive the par value while accepting a lower coupon all these 8.5 years, right? Or he can sell the bond, right? Now the prices of these longer term bonds would go down, right? Why? Because now these bonds have become unattractive, right? So the uh, investor B who invests in this long-term bond would have to sell this bond at a discounted price because now this bond has become unattractive, right? So in either state of the world, right, in either state of the world, right, investor B would be hurt more than investor A when market rates of interest increase, right? So we can conclude that longer term bonds are more volatile than short term bonds and more risky for the investor, right? So the issuer of longer term bonds would have to offer higher yield to investors to compensate for the higher risk, right? So basically saying that longer term bonds would have to be issued at higher yields compared to shorter term bonds, right? So if we plot the yields of bonds, right? If we plot the yields of bonds on this scatter plot, right, with time to maturity being on the x-axis and YTM on the y-axis, right? So basically the idea here is guys that this is the yield curve where we plot the YTM of bonds with similar credit risk but varying time to maturity, with the YTM being plotted on the y-axis and time to maturity being plotted on the x-axis, right? And we have already seen that longer term bonds should offer higher yields to investors compared to shorter term bonds, right? So we can say that this yield of this 10-year bond should be greater than the yield of the 2-year bond, right? Because the 10-year bond is more risky than sorry, this longer term bond is more risky than the shorter term bond, right? So the yield curve is normally upward sloping, right? Because longer term bonds should offer higher yields as they are more risky. But this is always not the case, right? The yield curve tends to get inverted or it flattens out, right? When investors believe that a recession is on the horizon, right? When investors believe that there is some greater risk out there which outweighs the risk of longer term bonds, right? They, you know, this is the reason why the yield curve tends to flatten or gets inverted. Right? When investors believe that there is some risk which outweighs the risk of longer term bonds, right? So this could be because investors believe that future interest rates are going to decline and they rush to secure current long term rates. When they rush to secure current long term rates, they buy long term bonds. When they buy long term bonds, prices of long term bonds increase. When their prices increase, their yields decrease, right? So this collective action of all the investors, yeah, right. What happens? This collective action of all the investors forces the yield to go down, right? So when the yields of long-term bonds fall, it may so happen that the yield curve tends to get inverted or it tends to get flattened out, right? Because yields are decreasing as prices of long-term bonds are increasing. Right? So this is basically the case with respect to yield curves, right? But guys, we used a single discount rate when we used YTM. We used a single discount rate to value all cash flows, right? So that assumed that the yield curve was flat, right? That assumed that the yield curve was flat. But yield curve is not always flat, right? So basically, a flat yield curve is basically telling you that uh, long-term YTM, the YTM of longer-term bond equal the YTM of shorter-term bonds, right? The YTM of longer-term bonds equal the YTM of shorter-term bonds. This is what a flat yield curve is telling me. But this assumption is incorrect, right? This assumption is incorrect. The yield curve will not always be flat, right? So there is a disconnect when we value bonds using YTM, because YTM is basically a single discount rate, right? Because YTM, irrespective of what the investors in the market believe, always assumes that the yield curve is flat, right? But the yield curve would be upward sloping when the participants in the bond market feel that everything is okay with the economy, right? And they should receive higher yields on long-term bonds, right? So in that case, the yield curve would be upward sloping. But when the investors believe that there is a recession on the horizon, right, the yield curves gets inverted. I explained the reasons why, right? Now, when I use spot rates, right, when I use spot rates or a sequence of spot rates to price a bond, right, it takes into account or it factors in the shape of the yield curve, right? It factors in the shape of the yield curve, right? If spot rates are increasing as you know, if spot rates are increasing as maturities are increasing, right? That is, long-term bonds are having higher spot rates than shorter term bonds, right? Then the investors believe that everything is okay with the economy. But when long-term bonds have spot rates lower than that of shorter term bonds, right? The investors believe that there is a recession which is on the cards, right? So basically, when I use spot rates, I am factoring in the future interest rate beliefs of the participants in the bond market, right? And this is the reason why it is a more fundamentally sound approach, right? So, guys, now since we have discussed this, right, and we've already discussed that spot rates are nothing but the YTM of zero coupon bond, let us do a small exercise as to how to value such bonds, right? Let us do a small exercise as to how to value such bonds, right? Say there is the spot rate for a 1 year spot rate is say 3%, 2 year spot rate is 4%, 3 year spot rate is 5%. So basically this is suggesting that the yield curve is upward sloping, right? So it is basically suggesting the yield curve is upward sloping. The yield of longer term bonds are greater than the yields of shorter term bonds, right? Now, say we need to price a bond. We need to price a bond which pays 5% coupon, right? For for say for a maturity of 3 years and a par value of $100, right? So this bond would pay $5 here. You would pay $5 here, and you would pay $105 here, right? So what we do is, right, we discount the cash flow with the associated YTM. We discount the cash flow with the associated, sorry, not YTM, with the associated spot rate. We discount the cash flow with the associated spot rate, right? So, how do we do this, right? So, $5 cash flow occurs at the end of the first year. The spot rate, 1 year spot rate is 3%. So 5 divided by 1.03. Right. Then I receive $5 at the end of the second year. The 2 year spot rate is 4%. So I discount this $5 cash flow with 4%, right? And since it occurs at the end of the second year, right, I discount it for 2 years, right? And I receive $105 at the end of the third year. The third 3 year spot rate is 5%, so I discount it with 5%, right? And since this occurs at the end of the third year, I discount it by 3 years, right? So this is how I will price this bond. If I calculate this, right, the price of the bond is 100.18. Now guys, the price calculated using spot rate is the no arbitrage price, right? If the bond price differs from the no arbitrage price, right, arbitrage opportunity would exist in the absence of transaction cost. So guys, this is the no arbitrage price, right? This is the no arbitrage price. Right? So if the price of the bond of the price of the bond in the market is different from this price, arbitrage opportunities would exist, right? And guys, we can also calculate the now we can since we have the price of the bond, we can also calculate the YTM of the bond. How do we do that? I have the price of the bond as 100.18, so my present value is minus 100.18. My future value is 100, right? My future value is 100, right? PMT is 5, right? N is equal to 3, CPT I by Y. So whatever answer we get for I by Y would be the YTM of the bond. I don't have my calculator with me right now, but this is how we can calculate the YTM of the bond, right? So the basic idea is that using spot rates, which are nothing but the YTM of zero coupon bonds, we are basically factoring in the shape of the yield curve while valuing the bond, right? We are factoring in the shape of the yield curve when we are valuing the bond, right? But when we use a single discount rate to value all, when we use a single discount rate to discount all future cash flows of the bond, we are not factoring in the shape of the yield curve, or we are not factoring in the beliefs of the investors with respect to future interest rates, right? While pricing the bond, we are basically assuming that the yield curve would be flat, right? Which is which may not be the current scenario, right? The current scenario may be that the yield curve is upward sloping, but while using a single discount rate, we would assume that we would be assuming that the yield curve is flat, right? So this is with respect to spot rates and bond pricing, right? I hope you are clear with this, right? Thank you so much, guys.